XRP traders' eyes breakout above $2.11 as US ETFs cross $1 billion milestone. A breakout above $2.11 is needed to trigger momentum towards higher resistance levels, while failure to hold $2 could lead to a retest of $1.95. Token breaks above key support while volume surges 251% during psychological level defense at $2. US spot XRP ETFs continue pulling in uninterrupted inflows, with cumulative demand now exceeding $1 billion since launch, the fastest early adoption pace for any altcoin ETF. Institutional participation remains strong even as retail sentiment remains muted, contributing to market conditions where large players accumulate during weakness while short-term traders hesitate to re-enter. XRP's macro environment remains dominated by capital rotation into regulated products, with ETF demand offsetting declining open interest in derivatives markets. The defining moment of the session came during the $2.03 $2 flush when volume spiked to 129.7 m, 251% above the 24-hour average. This confirmed heavy selling pressure but, more importantly, marked the exact moment where institutional buyers absorbed liquidity at the psychological floor. The V-shaped rebound from $2 back into the $2.07 to $2.08 range validates active demand at this level.XRP continues to form a series of higher lows on intraday charts, signaling early trend reacceleration. However, failure to break through the $2.08 to $2.11 resistance cluster shows lingering supply overhead as the market awaits a decisive catalyst. Momentum indicators show bullish divergence forming, but volume needs to expand during upside moves rather than only during downside flushes to confirm a sustainable breakout. XRP traded between $2 and $2.08 across the 24-hour window, with a sharp sell-off testing the psychological floor before immediate absorption. 3 intraday advances toward $2.08 failed to clear resistance, keeping price capped despite improving structure. Consolidation near $2.06 to $2.08 into the session close signals stabilization above support, though broader range compression persists. The $2 level remains the most important line in the sand, both technically and psychologically. Institutional accumulation beneath this threshold hints at larger players preparing for medium-term expansion phases. The clean break above $2.11 is required to ignite momentum toward the next supply zone near $2.20. $2.26. Failure to hold the $2 floor risks a retest of the $1.95 area, where ETF-driven buying may reappear. The divergence between rising institutional demand and flat retail participation continues to create asymmetric upside conditions if resistance levels break.